Hello and welcome to another 30-Minute Thursday. My name is Amit. It is 2 p.m. in the still summery Pacific Northwest. We are live on Facebook, and I am coming to you guys from the beautiful studios at the Kirkland office of New American Funding. And I'm a little bit harried and frazzled. As always, there's lots going on in the world. There's lots going on in my world. I hope everyone's world is going great. I hope you guys are staying safe, staying healthy, staying sane, of course. And before we jump in, I just want to share with you guys for my family and friends who celebrate the Jewish New Year, which is coming up starting tomorrow. Tomorrow evening starts the Jewish New Year, and all Jewish holidays start in the evening the day before. And the reason for that is because in the Old Testament, when we talk about creation, there was darkness and there was light. That was the order in which things happened. And so we do that for the Jewish holidays in the same way, wherein we do the night before, so it goes from sunset to sunset the next day. So to all of my family and friends who are celebrating and observing the Jewish New Year, I hope you have a wonderful, happy New Year. Shana Tova Umetuka, a good and sweet New Year for the year ahead. And with that said, let me just expand my screen a little bit. All right, there we go. I don't know if you guys notice any difference, but for me, it's a little bit of a difference. So here we go. So what's going on with the Fed? Where are we going from here? What's going to happen next? Nobody knows. Honest to goodness, nobody knows. And I'd like to tell you that I know, but if I did know, I'd be somewhere where I could make a substantial investment on that guess or on that premonition, but nobody knows for sure. The Fed meets again on the 20th of this month, so a week from yesterday. They meet for 2 days. Wednesday next week, they're going to talk about it, and Thursday next week, so a week from today, they're going to decide and tell us what they've decided going forward with regard to their short-term rate hikes and with regard to trying to beat inflation. Now, where we are right now is at a crossroads. It's a very strange place because we're just not sure. The Fed's biggest concern right now, I'm assuming, guys, I mean, please, they don't consult with me, and I'm certainly not in their heads. And there's a lot of members of the Fed, so it's not a monolithic one person or even a couple of people. There's quite a few people, and there's quite a few voting members. But what they're most concerned about, in my opinion, is the expectation or the fear, I should say, that they're being faked out by inflation, that it goes down to start with and then it shoots back up. We call that a head fake or some other like double dip or double peak or something like that, where they take the foot off of the brakes. What they're doing right now is they're trying to create braking system in the economy. Braking, B-R-A-K-E, as in stopping the car. Although it's funny because oftentimes the Fed does things until something actually breaks in the economy, and that's B-R-E-A-K, right? They're doing both basically, but the question right now is, will they hit the brakes on raising interest rates and risk a double top of inflation, meaning that we hit this peak, we came down and they got faked out and then it went back up again. That is their concern, and they don't want that to happen. And so in order to avoid doing that, they may continue to raise short-term interest rates to make sure that inflation is really contained. So that is one of the roads on the crossroad, right? So the road going this way, but then we come to this other side of the road, which is inflation actually contained? Have they done enough to actually bring down inflation and create a system or situation where they've actually managed what no one expected them to be able to manage, which is a soft landing, which is basically eliminating inflation or containing inflation without causing a recession or other trauma to the general economy. That would be great if they can do that. I don't know that they can. I don't know that they will, but that would be fantastic if they can manage that. So what they're looking at, though, are statistics from the Bureau of Labor Statistics. And you guys, if you followed my Facebook Lives you know that I'm not a huge fan of statistics, and those things can be tortured in any which way in order to get the numbers to tell you what you want. And I think that the Bureau of Labor Statistics as an institution has probably been wrong more than they've been right. And I've said that out loud. I've shared with people how they've had to revise a lot of their different numbers from month to month to month. And they're always negative revisions, meaning that you get a rosy picture at first, and then you get a less rosy picture later on when they revisit the numbers and reassess. But what has come out recently from the Bureau of Labor Statistics are inflation reports on the consumer price index and the producer's price index. And I'm going to jump in here and share with you guys what these things really are and talk a little bit about how they're tabulated and what they mean, and then kind of put that into context of what the Fed's looking at. Keep in mind that the Fed has been accused by many people, myself included, of looking backward rather than looking forward, meaning that they're driving while they're staring in the rearview mirror and not staring out of the front windshield. And they tend to do that because they want to be, quote unquote, data driven, and the data is coming from the Bureau of Labor Statistics, among others, but it's backward looking. It's not the fault of the BLS, the Bureau of Labor Statistics, nor is it the fault of the Fed. And I can fault these institutions for many things, but this I cannot. No one can go back in time and push forward. No one can predict. So the Fed waits to get reports. The reports are at least a month, in some cases longer, from the past. So what happened in August is relevant to the Fed, but what's happening right now in the middle of September is more timely. And so juggling these things is a bit of a problem for the Fed. And this is why myself and a lot of other people accuse the Fed of driving with their in the rear view mirror rather than out the front windshield. But in any event, yesterday and the day before, we received numbers, or today and yesterday, we received numbers from the Bureau of Labor Statistics on the consumer price index. That was yesterday. And today was the producer's price index. I'm going to cover the producer's price index first because it's the Rodney Dangerfield of these economic reports. The PPI, as it's called in shorthand, is the report that gets no respect. And the reason it gets no respect is because while it is a measure of inflation, it is a measure of wholesale inflation, meaning a business to business sort of inflationary trend. This is what producers of goods pay for the raw materials that go into those goods. And while that is important, it's not always applicable in tracking consumer-based inflation, because in some cases, the producers will pass those costs on to the consumer by way of higher fees or higher charges for their products, but in some cases they won't. And so it's hard to see exactly how things go with the producer's price index. Now, we did get, to a certain degree, a slightly higher rate on the PPI. And that was expected, and it came in within expectations, but you know, it kind of made the markets a little bit uncomfortable because it showed that the cost of things is not going down as quickly as possible. Now, that is a little bit of a tricky thing, because remember, this is for the month of August. It has been several weeks since these measures were taken and since these numbers were tabulated, and things are moving forward, not backward. So it's a little bit odd, but the PPI came out a little bit hotter than we wanted it to be, but within the expectations of what it will be. Now, remember, things don't go straight up or straight down, right? They have vacillations. They go up a little bit, they come down a little bit, they go up a little bit, they come down a little bit more. They have trends within that, but it's not straight up or straight down. So this is part of that process. But the PPI came out today and it was okay. The CPI, the Consumer Price Index, came out yesterday and it was also okay, a little bit hotter than we would like it to be. And so in theory, inflation's going up. And the Fed hates that. They don't want to be faked out by that. They don't want to start cutting interest rates or hitting a pause on raising interest rates and then get faked out by higher inflation, and they've got an even bigger problem. Inflation is one of those things, you got to kill it quickly or else it just spins out of control. So the Fed's doing the best they can. I think I give them the benefit of this doubt, and they don't want to be faked out by it. So the readings came out a little bit hotter than we'd like, but within the expected range. So we saw this coming. Now, CPI has a couple of different things going for it. There's two reports. There's the headline number, and then there's the core number. And those two things are slightly different calculations. The headline number's got everything in it. And that includes two components that are not reflected in the core. And the two components are food and gas, or food and energy. And that is, the reason for that is because the Fed cannot control food and energy consumption by raising or lowering interest rates. These are necessities that, by definition, we're going to buy whatever the cost may be, right? I mean, you cannot go without food for too long, right? You may buy different food. You may buy, instead of steak, you may buy hamburger or something of that nature, but you're still going to buy food. And you may, moderate your consumption of fancier food based on costs, but you still need food, right? Same thing with energy or gas. You still need it, even if it's expensive. And in Washington State, by the way, I'm not thrilled to report that we have the highest gas prices in the nation. That's not something that's great for us. And certainly coming from Texas, I don't like to see stuff like that. But the headline number includes gas or energy and food, and the core number does not. And the Fed should be focused, and has told us that they're focused on the core reading, because this is something that they can control by their interest rate policies, by their money policies. So the core reading is coming down a little bit, which is awesome. The headline reading, not so much. The headline reading is going up a little bit. And the reason is because gas prices, oil prices are going way up right now. I don't know if you guys filled up at the pump recently, but for me, by my house, just as an aside, I filled up today, and I have to get the super unleaded, the Supreme, whatever, and I'm paying $5.58 a gallon, and that's near my house. It's convenient, but it's not a great price. But oil prices are going way up. Oil as like a resource, a commodity that's traded on the commodity exchange, for 1 barrel of oil now, it's costing more than $90. And our allies, if you want to call them that, our trading partners in Saudi Arabia, as well as Russia and the other oil producing nations, we call that OPEC, right? They have decided that they're going to cut production of oil. And that means they're going to pump less of it. That means they're going to sell less of it. That means that the cost of it will go up. And that in and of itself is inflationary. And there's not a darn thing we can do about that other than try to convince them differently or produce our own. I would be happy to see both of those things happen. Again, this is not me talking politics. This is not me talking about energy policy or climate change issues or anything like that. I just am a person that believes that we need to use these resources while we have them and while we're looking for other options for energy. But oil prices are going up. Gas prices are going up. And as a result of that, the producer price index is going, the consumer price index is going up. And that is going to reflect that inflation is going up. But there are other things that are going down. So let me tell you how the consumer price index is calculated. It's really interesting. There are a bunch of categories of expenses that the BLS, the Bureau of Labor Statistics, looks at and gets tabulates. The big one is the cost of shelter. Shelter is about 44% of the total number that goes into the consumer price index. So shelter costs are way expensive, or a huge component. Whereas other things like entertainment or clothing or used cars or car insurance, those are smaller components, right? They still add up, but they're smaller weightings than the big one, which is cost of shelter. Now, auto insurance, interestingly enough, is up like 19% year over year. The cost of insurance is continuing to go up, and I don't know why that is. That's a curiosity for me. It's a bit of a head scratcher, as they say. But we'll sidestep that for a moment, and we'll talk about the cost of shelter. Shelter is a really big one. Like I said, 44%, so almost half of the index is made up of just this one component. And we had a huge spike in the cost of shelter, the cost of rent for the last year, the last 18 months, really. We've seen rents go way up. The thing about rent is it's a lagging indicator for the total picture of this. The reason why it's a lagging indicator, and what does lagging indicator mean? It means that it trails behind. It means that the information we're getting on rent and shelter costs is old data. It's the oldest data that we're collecting for these statistics, because when you don't sign a lease every day, you don't sign a lease every month, you sign a lease typically once a year. And so once that lease is done, that number is tabulated. Even if rents are going down later on, we still have these higher numbers from last year that we're cycling through. Now, the rent costs, the cost of shelter, have, if you look at it on a chart, they've actually crested and they're starting to come down, which is awesome. That's great. But they're still not coming down very quickly because, again, it takes time for all of these leases to be renegotiated, for all of these things to be re-signed and whatnot. And so that is a lagging indicator in the total composite of the consumer price index, but it's a big indicator. It's 44%. So if you look in real time, and I'm not going to bore you with the math of how the prognosticators and the researchers that I subscribe to did this, but if you look at rent in real time and you add 44%, or you multiply it times 44%, and you add it to the actual consumer price index of what's going on, we would be in a much different place. We wouldn't be in the mid fours. We'd actually be in the mid 2% range, which is still hotter than the 2% total that the Fed wants, but it is much closer to where they want to be than where we think we are, based on looking in the rear view mirror on especially on shelter costs. So that's why I say we're at a crossroads, because in truth, it appears at least that things have been moving in the right direction. And in theory, the Fed should hit the brakes. That's stopping the interest rate hikes, pausing them a little bit before something breaks, like they smash the economy completely. In theory, they should do that. Now, I know that they're worried about this being a head fake, and you hit pause on the interest rate hikes, and things spiral out of control again, and then it becomes really difficult to contain inflation. So they've got to balance this thing out. But in theory, we are looking, in real time at least, a lot better on inflation than we think we are. But again, will it pop back up? It's kind of like whack-a-mole, right? That old game where you hit mallets on these little animatronic things that pop up out of a table. They want to make sure that they hit every last one of these things and make it so that inflation is really contained. So we're not sure yet, but let me take my time. We're good. The Fed meets again, like I said, September 20th, and then they're going to have another meeting at the end of November. They meet every 6 weeks. After that, is at the end of November, beginning of December. After that, I think they're done for the year on their schedule. So they're only got a couple more meetings to make decisions that affects the economy. And they have said that they want to see higher unemployment. I talked about that last week, and that's a component of what they're looking at in totality for their interest rate hikes, or pausing their interest rate hikes. So they are going to be looking at those numbers as well. But the question is, that's so weird. I put my phone on do not disturb, and And for whatever reason, it has decided to chime in. Strange things are afoot here. In any event, sorry about that, guys. We'll see what happens with the information that the Fed gets. The question is, will they get it in time before they make their policy decision this month? Hard to say. I don't know if they're going to get it in time. But in any event, when this inflation comes down, and it is, and it will, mortgage interest rates will come down as well. The Fed's got three options. Only three that they can do with interest rates. They can raise rates, they can lower rates, they can keep rates where they are. That's it. That's it. And at some point, the Fed will stop raising rates, and they may very well even lower interest rates. And when that happens, I will tell you that mortgage interest rates will come down as well, significantly. And that is going to mean that a lot of people that are waiting to buy a house, that are waiting to get back into this market and waiting for interest rates to come down on mortgages, they're going to re-enter the market with a vengeance. And the statistic that I read that I'm going to hold on to for a little while longer is that for every 1% the 30-year fixed rate comes down, we're looking at 5 million more buyers coming back into the market nationwide. So that's a ton of competition for homes that is sitting on the sidelines waiting to jump back in to make their home purchase decisions. And so I urge my clients, I urge my referral partners to urge their clients, if you're even remotely thinking about buying a home, now is the time to do that. Do it before all the competition comes back in, because we already have a major shortage of inventory. And that's not getting better. In fact, that's getting worse. And so prices are high. Home values are holding steady and actually rising because there's no inventory. And so basic supply and demand economics still plays here. If you've got no inventory, zero supply, and much demand, then the price is going to go way up. And that's what is going on right now. In fact, the statisticians are projecting anywhere between like a 5% to 10% increase in home values over the course of this year, where we're seeing that right now. And so this continues. And again, when people jump back into this market with both feet, which they will, because there is definitely a need for housing in this market, when they do that, it's going to push the prices up. It's going to push the values up. It's going to push the competition up. And it's going to be more difficult for people to buy their home when other people are competing for it. So right now, we've got a little bit of a lull in the action, as they say, and that is an opportunity for people to get a home under contract and have an inspection, and maybe even get the seller to pay for some of the closing costs, or do some repairs, or do a temporary interest rate buy down for you. Like, there's still things happening in this market. It's really interesting. I have clients who wrote an offer yesterday. The house was listed for $530,000. It was on the market. It's been on the market for 51 days. And they wrote a lowball offer. They didn't get it. Somebody came in and offered cash at a higher offer price, and that's happening as well. But the house had been on the market for 51 days. And now all of a sudden there was a competing offer, and that's kind of frustrating. But it's interesting to see that there's some inventory sitting right now. I've got a very good friend who will go unnamed because, well, he'll just go unnamed, but he's got a listing, and we're doing a 2-1 temporary buy down for that property, meaning that the sellers are going to credit about $22,000 towards the buyer's reduction of interest rate and mortgage payments for the first 2 years. So there are things like that happening as well. And then I've got other listings and other sellers and other buyers who are looking at properties, and there's multiple offers already, and there's, just a lot of demand for it. So it's a really strange market right now, but there's still opportunities, is the point. When these interest rates come down, and they will, maybe not this moment, maybe not even next month, maybe not even until next year or the year after, but they will come down. And when they do, guys, there's going to be a ton of interest coming back into this market, and that's going to push everything much higher. So I recommend to anybody who is looking to buy a home, now is the time to do that. Buy the house now, marry the house, date the rate. Buy the best house you can afford. Don't worry about the payments. I know that sounds weird, and I'm not looking for people to be irresponsible, but I am thinking that in a year or two, we're going to see interest rates come down, prices will go up, we will refinance, and you guys will get a lower interest rate. I know you're going to be making higher payments for the first year or two until that happens. I get that. But when we were in 2021 at the height of the rush to buy real estate, and there was no inventory and interest rates were really low, people were paying 15% on average. For me, at least, my clients were paying 15% above the asking price. So if the house, just easy math, was going for $1 million, then they were offering $1,150,000 just to get the seller's attention. So how much is that costing you, as opposed to buying the home at the asking price, or maybe even a little bit less than the asking price if it's been on the market for a while? And yes, you're paying higher interest rates. That means you're paying higher monthly payments, but I assure you it's not going to be as high as what it would be in 2021 when people were offering 15% above asking price. That's a lot of money out of pocket. That's a lot more to pay for your house. So the opportunity is now. We are at a crossroads. Let me check my time. We're just about there. We are at a crossroads. We're not 100% sure when things are going to happen, but we are starting to see in real time, at least, that the rate of inflation is coming down. As that happens, the cost of interest rates will come down. The Fed will moderate its position as well. I don't know if it's going to happen at this meeting. They may say, hey, let's just nail one more, into this inflationary bubble. Let's pop one more, put another pin in this thing, or another couple of nails to make sure that it's really deflated. But at some point, they're going to make a change. And when that happens, and all these other buyers come back into the market, guys, it's going to be tough. I'm looking forward to it, to be honest with you, because there's going to be a lot of people to refinance and a lot of people to help finance for their purchases. But as the buyers go, it's going to be a lot of competition, and that's going to be potentially challenging. So now is the time to do it. As they say in the Chinese proverb, the best time to plant a tree was 20 years ago. The second best time is right now, today. So with that, please call me if you want to talk about interest rates. Call me if you want to talk about strategizing for buying a home, for refinancing an existing mortgage. We can definitely work with that. And until I hear from you, I will see you next week, of course. But in the meantime, I want to wish all of my Jewish friends and family, anyone who's celebrating the Jewish New Year, a happy and sweet and prosperous and healthy New Year. And to the rest of you guys, I hope you have a fantastic weekend. Thank you so much for spending a little bit of time with me today. Stay safe, stay healthy, stay sane, and I will see you next week. Thank you very much. Y'all take care.